Welcome back. You're watching HFO-TV, co-sponsored by AMF Capital, the Baljanik Law Firm, the Butler Exchange Group, and the construction firm J.R. Johnson.
Welcome back to HFO-TV. I'm Greg Frick, partner at HFO Investment Real Estate. Here I want to just give a quick market update here as we're wrapping up the end of summer during this interesting time in 2020 with still in the middle of this pandemic. And we get asked a lot about what we see as apartment brokers in this market, in the kind of Oregon, Washington market and multifamily. So I want to give kind of an update on that. And then again, we've done other videos recently about some of the legislation that's passed from the foreclosure moratorium, the eviction moratorium. So I would recommend for people that are interested, please take a look at those. There's a lot of information that can help you as you navigate through this interesting time period. For a market update, what we're seeing in this market is, the big question is rent collection, and it has not been as bad as I think we were expecting when we started going into this in the beginning of March. We've steadily seen percentage of collections have gone down month by month, but it's nowhere near some of the predictions that we had heard back in mid-March. I think we started off in April and May. We had some properties that had no issues with collections, and other ones were bouncing around 5 to 6% of some kind of deferral for rents. We had the eviction moratorium put in place back in March, and then since then we've seen a little increase. But again, where we are today versus where we thought we would be, it's much better. Now, part of the question is, as the federal stimulus runs out, are we going to see more tenants taking part in not being able to pay their housing cost? And as I said, as we've gone through, July and August collections are trending to be a little bit below where we were in the previous months. And a lot of it, the interesting thing on this is it's really building by building, management by management. We'll have one property that's doing fine, and next door they may be at 10 to 15%. And it's really unique. It's not across the board as to which ones are doing worse. We do suspect that some of the Class C projects, as this goes on longer, we'll see some higher deferrals of rent payment here in the future. But as of right now, it's better than we thought. As of last month, we were running percentages around 10 to 15%. And again, it really depends on the property. It depends on the tenant mix. It depends on the relationship with the management company and the tenants. And so that's been very interesting to see. In terms of vacancies, June actually we saw a lot of move-ins. We are seeing a little slight tick up on vacancies now. I think some of that is as this has gone longer and people are maybe hunkering down. There may be more groups kind of walking away once their lease expires or looking to make other plans. So we have seen a little tick up on that. So in how we're underwriting, we're having to put a little bit bigger vacancy percentage in place due to what we're seeing in the pandemic. So that's kind of an interesting, but I'll go through a couple things. We'll start kind of with permits. As you can see, we had a huge run up in permits in 2017. And because of that, that had a lot to do with inclusionary zoning. People had to get their permits in by, I think it was February 2017. So we had this artificial kind of bump up. We've had a significant amount of permits in 18 and 19 had a slight pump up as well. But again, it's nothing that we saw in 2017. As of June of this year, we've seen a significant decrease. I think we're under 4,000 units permitted in. I think a lot of that has to do with not only the artificial bump up because of inclusionary zoning of people trying to get their permits in. We've also had continued increase in cost and construction costs. And as you have a slowdown in rent growth, which we'll talk about in a minute, combined with that, it's getting tougher and tougher for making projects pencil. With the inclusionary zoning part now, you have to come in. There's an affordable component part on that, added with the added cost. There's also a commercial activities tax now, which again just adds to the cost of bringing supply online. And I think that's why we're seeing a slowdown in permitting. We figured we would see a slight slowdown based on 17 because of, again, when they put inclusionary zoning. But we've had a pretty big drop this year, and it's coupled with a couple things. The cost of construction, some of the regulations that have been put in place, and the slowdown in rent growth. So because of that, I think we're going to see less units coming online. We've had a lot come online in the last couple of years, and because of that, absorption's been a little bit slower. Again, a lot of the construction is concentrated on the inner inner city, close in east side, close in west side. We are starting to see some units in North Portland. South Waterfront has some units as well. So it is starting to spread out in suburban. But again, the big thing is going to be cost. Are they able to achieve the rents they need to get to offset the added cost? There was a hope if we had a slowdown in permits that we would see maybe construction costs come, but there's enough projects out there that's just not the case. So we're going to have to see a little equilibrium where rents are going to kind of come back to offset the added cost of construction, because of right now there has not been a significant decrease in what it costs to bring a project online. And because of that, you're going to see a slowdown in terms of new multifamily. There have been some talks of condo projects that just hasn't. There's one building that was going to be condos built within the city here, close in Northeast, mid-construction converted back over to apartments, and now they're in the lease-up phase. So that market hasn't really come back, though you do hear in talking to groups that are involved in single family that market's very strong. I think a lot of that has to do with interest rates and just a lack of product being put on the market, as we've seen when people are indecisive of what's going on, job, economy, they'll have a tendency to hunker down. So I think because of that, you don't have as many houses out for sale, and you do have people still buying, trying to take advantage of rates. And that's why I think you're seeing, demand on the single family side really getting aggressive. But again, in our world, we're not seeing a lot of talk about going to condos or conversion to condos, which is kind of interesting. On the transaction side that we have seen, there's definitely been a slowdown in transactions. Depending on what you're looking at, we're probably looking at 20 to 30% in the second quarter of transactions dropping down. We have been doing them. It's been a little bit more difficult because of due diligence, frankly, and how do you get into a unit? How do you get in and really do deep due diligence on a property if we've got issues about getting in and seeing various aspects of the property? But we are seeing transactions have gone down, both institutional, 15, 20 million and up, and what we call private client, 10 and 15 million and below, have both seen a slowdown in transactions. I thought it would probably be more than we saw. I think you've seen a lot of product that was going to come to market first part of second quarter kind of get pushed out, and now you're starting to see more properties come on the market. I think that has to do with not really knowing how we were going to handle things come in March and April, kind of trying to get a lay of the land, and now you're seeing those come out for a variety of reasons. I mean, I think one thing that's kept demand strong from capital and looking to invest is just interest rates. They are historically as low as I remember. Capital is still out there. Your leverage is going to be a little less, but your rates you're going to get is very, very attractive. So it's hurt in terms of the amount of leverage that you can achieve in buying, but that's offset by the amount, the interest rate and the terms. We're seeing things sub 3, interest only, and that's helped fuel people looking to continue to invest in assets. And I think it's also, as you've looked at, people are looking for yield. In our world, multifamily has felt some of this, but not to the brunt of retail and office. And so because of that, you do have a lot of capital still trying to get into this market in terms, and that's kept cap rates pretty steady. In terms of vacancies, we've discussed, we've seen, Multifamily Northwest came out with a report. We've seen a steady increase in vacancies across the board. Different submarkets have different kind of numbers, but we are getting closer and closer to 5% on the vacancy number. It'll be interesting to see, where August shakes out in September, depending on what happens with the stimulus. That's a big question for everybody. The other thing we are noticing in terms of collections, I should have mentioned this before, is collections now, because of the way there's no fees charged for not paying by the 5th. When we look at collection numbers, used to be we'd look at the 15th and say, hey, how was collections for the month on the 15th? We really now need to look, at the end of the month, because you're having rent payments come through, all through the month as people have, getting money for the ability to pay. So that's been kind of a change in how we're looking at projects, not just taking a snapshot of, at the 10th or the 15th of the month, where are we in collections? We're actually going to look at the 30th and see for that previous month, due to kind of the changing dynamic of how people and when people are paying rent. Now it'll be interesting, that may change if the eviction moratorium ends into September. Then property owners, their theory, could start having fees for late rent, but we'll see what happens. See what happens when that when that comes. So In terms of rent per square foot, it's been relatively flat. As I said, as vacancies have gone up, we have not seen massive rent increases. We've seen, if anything, we've seen concessions in the core Class A product. I think that's due to a lot of deliveries that have come in place, as well as some softness in that market. But for the most part, we are not seeing, we're not penciling massive rent increases. We're looking at heavier vacancy, some kind of allocation for, delinquent rents, and how that looks is kind of what we're seeing moving forward. So in summary, as I mentioned, things are not as bad as we, I think, expected when we started this. Well, when we kind of got in the middle of this pandemic in March, collections have been better. From an underwriting standpoint, the interesting thing is how are we going to look at the rent that's been deferred? Again, it's owed. There's not rent forgiveness. So that's been kind of an interesting thing as we get further along in this, how different groups underwrite that and the discounts for that. Interest rates have continue to drive this market. With the low interest rates environment that we have, we continue to see capital looking to invest in multifamily. And this, the Pacific Northwest is, now, on the map in terms of capital coming up here. There have, talks with some of the stuff going on in Portland specific. Some groups looking to maybe get out of Portland, going in some tertiary markets. So I think we will see more of that as things progress here in Portland. But all in all, we continue to see capital. Leverages are lower. We've not seen a significant change in pricing due to interest rates and due to demand. But again, this is kind of a moving target. It'll be interesting depending on what happens with stimulus and things like that. Or depending on, if we have a change in administration or based on the election, does that change some of the tax planning and estate planning moving forward? So we'll do another update here real soon. Please, everybody, be safe, and we'll talk to you soon again on HFO TV. Thank you very much.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.